If you're watching the metals market this Monday morning, stop scrolling for a second and look at silver, because something important is unfolding right now. I'm talking about a metal that just suffered a historic 34% collapse and is now hovering near that fragile $80 to $82 zone. That's not normal behavior, that's stress. And here's the part most headlines aren't telling you. The real trigger isn't just profit-taking, it's a sudden shift in what markets believe the Federal Reserve is about to become. President Trump's nomination of Kevin Warsh just hit the psychological wiring of global markets, and traders are repricing risk in real time. Stay with me, because I'm going to show you exactly what's happening beneath the surface, and more importantly, how you can recognize this pattern the next time it starts forming before the crowd catches on. Before I explain what caused this cascade, let me teach you something most investors learn too late. Metals don't just trade on supply and demand, they trade on expectations. Think of the market like a massive thermostat. It's not reacting to today's temperature. It's adjusting for where it thinks the climate is heading, and that distinction matters more than almost anything else you'll hear this week. Here's what you need to know about monetary expectations. When markets sense tighter policy ahead, even if nothing has actually changed yet, assets that thrived on easy money suddenly look overextended, silver especially. Why? Because it tends to attract momentum traders when liquidity is abundant. It's the speculative play, the leveraged bet, the thing you buy when you're not just protecting wealth, you're chasing returns. So, when the narrative shifts from money will stay cheap to discipline is coming, you don't get polite selling, you get exits, fast ones, and that shift doesn't require the Fed to actually raise rates tomorrow. It just requires traders to believe that the environment is changing. That's the power of expectation. It moves billions before reality even shows up. If this is making sense, drop a comment and let me know where you're watching from. I want to know who's paying attention to this stuff. Now, here's what's actually happening. Let me break down the sequence so you can see the gears turning. First, the Warsh nomination signals a potentially less accommodative Fed. Kevin Warsh isn't exactly known as a dove. He's viewed as someone who values price stability over market comfort. That alone forces traders to rethink inflation trajectories, real yields, and speculative positioning. It's not about what Warsh will do, it's about what traders think he represents. Perception drives positioning. Always has. Second, the geopolitical temperature is cooling, particularly renewed US and Iran talks. When global tension drops, safe haven demand quietly evaporates. Investors start asking themselves, do I still need this hedge? If the world isn't ending, if conflict risk is declining, then why am I paying a premium for protection? That question alone can drain billions from metals overnight. But here's where convergence matters. Silver wasn't just rising before this. It was crowded. Overcrowded trades behave like packed theaters with one small exit. The moment sentiment flips, everyone runs for the same door. And it doesn't matter if you're first or last. What matters is that the door is too small for everyone at once. Now, layer on what happens next. This is where it gets mechanical. Volatility spikes automatically trigger higher margin requirements in futures markets. That means leveraged traders suddenly need more cash just to hold positions. If they can't post it, forced selling, no choice, no debate. The broker liquidates your position whether you want to hold or not. So, when the initial drop hit, it wasn't the end. It was the beginning of a mechanical unwind. Algorithms detect momentum, stops get triggered, brokers issue margin calls, positions liquidate regardless of conviction. You could still be bullish on silver long-term and still get forced out. That's the structure working against you. Price falls not because everyone turned bearish overnight, but because the structure demanded it. The system itself created selling pressure that had nothing to do with fundamentals. And that's what most people miss when they see a chart collapse like this. They think everyone panicked, but really, a lot of them just ran out of margin. But here's the part that should make you pay attention. This kind of forced liquidation doesn't last forever. It's violent, it's brutal, but it's finite. Once the leverage positions flush out, once the weak hands are gone, the market starts looking for a floor. And that's where we are right now. Now, let me show you what most people are missing. The panic liquidation has largely flushed through the system, which means this moment, right now, is less about fear and more about price discovery. The market is trying to figure out where equilibrium actually lives without leverage propping it up, without momentum chasers, without the froth. And if you're paying attention, this is where opportunity often hides, not in the panic, not in the initial crash, but in the exhaustion phase, when the selling slows, when volatility starts to compress, when the structure resets. This is the exact same playbook that's appeared across decades of commodity markets. Go back to 2011. Silver screamed higher, positioning got euphoric, margin requirements jumped, and the unwind was brutal. Different headlines, same mechanics. It went from nearly $50 an ounce down to the mid-20s in a matter of weeks. Sound familiar? Look at the 2013 gold correction. Policy expectations shifted, real rates climbed, and suddenly, what looked like a permanent bull market snapped into a deep consolidation. Traders who understood structure survived. Traders who only believed in the narrative got wiped out. Even the 2020 post-stimulus surge, followed by sharp resets, showed us something important. When liquidity narratives change, metals reprice faster than most investors expect. You saw gold and silver rally hard on stimulus fears, then pull back sharply when those fears moderated. Same pattern, same psychology. Zoom out, and you see the larger story. Markets overshoot in both directions. Always have. Probably always will. Because markets aren't rational calculating machines. They're collections of humans making bets with incomplete information and managing risk in real time. And humans overreact. That's not a bug. That's a feature. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this sell-off be overinterpreted? Absolutely. Markets sometimes overreact to political appointments. Warsh hasn't even been confirmed. He might not get the job, and even if he does, his actual policy influence might be limited. And yes, there are always whispers about manipulation when metals drop this fast. Maybe there's truth to that. Maybe there isn't. Here's the thing. It doesn't actually matter whether someone's pulling strings behind the scenes. The mechanics are what matter. You don't need conspiracy theories to explain forced deleveraging. Structure is enough. Could silver stabilize quickly? It could. If real yields soften or policy fears fade, buyers may step back in sooner than expected. There's always that possibility. Markets are dynamic, sentiment shifts. So, focus on what you can control. Watch positioning, watch volatility, watch liquidity, not social media narratives, not doom-scrolling headlines. There are probably 3 types of people watching this right now. And I want to speak to each of you directly, because your situation matters. First, you might be the long-term believer. You own silver because you see it as monetary insurance. Maybe you're stacking physical. Maybe you've held through rallies and corrections before. If that's you, volatility is the admission price. You knew this when you started, but you should still ask yourself, are you positioned so that a 30% drawdown doesn't force you out? If you're leveraged or overextended, this is your wake-up call. If you're holding physical with no margin to worry about, then this is noise. Painful noise, but noise. Second, maybe you chased momentum during the rally. No judgment. It happens. Silver was ripping higher. Everyone was talking about it. FOMO is real. What matters now is discipline. Are you reacting emotionally, or are you evaluating whether the original thesis still holds? If you bought silver because you believed in debasement, inflation, fiscal chaos, those things didn't disappear this week. But if you bought it because the chart looked good and now you're underwater, that's a different conversation. Be honest with yourself about why you're in. Third, you might be on the sidelines, wondering if this is a buying window. You've got cash. You've been waiting. You're asking, is this the dip? Here's what I'll tell you. Patience is your edge. Markets rarely bottom in a single dramatic move. They tend to base, retest, and exhaust sellers. So, don't rush. Watch for signs that the structure has reset. Watch for volatility to compress. Watch for stabilization, not just one green day. So, here's what I want you to answer in the comments. Which type are you? Are you holding through this? Did you get shaken out? Or are you waiting to see where this settles? Tell me your mindset, because that's what separates those who survive these cycles from those who don't. The universal principle? Liquidity drives everything before fundamentals catch up. If you understand that, you understand 90% of what's happening right now. Here's where I stand. I'm not panicking, and I'm not blindly bullish either. I'm observant. This looks mechanical, not catastrophic. and that distinction is everything. Let me tell you what I'm personally watching. First, I'm watching real yields. If they continue rising, metals face headwinds. Real yields are the opportunity cost of holding non-yielding assets. When they go up, silver and gold become less attractive on a relative basis. So if 10-year TIPS yields keep climbing, that's a problem for metals. But if they plateau or reverse, that's your signal that the pressure might be easing. Second, I'm watching futures positioning for signs that leverage has truly reset. The commitment of traders report will tell us if speculators have actually unwound or if there's still froth in the system. If positioning is still elevated, we could see another leg down. If it's washed out, then we might be closer to a floor. Third, I'm monitoring volatility, because when it compresses, stability often follows. You can see this in the VIX for equities, but also in metal-specific volatility indicators. When those start to calm down, when the swings get smaller, that's when smart money starts nibbling. Not when everyone's freaking out, when things get boring again. Based on my analysis, this crash wasn't random, it was structural, a repricing of policy expectations colliding with overcrowded positioning. The fundamentals, not erased, just being renegotiated by the market. Silver's industrial demand hasn't changed. Supply constraints haven't disappeared. The long-term case for monetary metals hasn't evaporated. What changed was the short-term narrative and the leverage supporting the price. And if history rhymes, the investors who understand the mechanism, not just the headline, will recognize the next move before it becomes obvious. They'll see when positioning resets. They'll notice when volatility compresses. They'll feel when sentiment shifts from panic to indifference. And that's when opportunities emerge, not in the chaos, in the calm, after. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Make your own decisions based on your own risk tolerance and financial situation. If you made it this far, you're the type of person who thinks independently. That mentality will serve you well. While everyone else is reading headlines and reacting emotionally, you're studying structure. You're learning patterns. You're building a mental framework that works across markets and across time. If this breakdown helped you see what's really happening, share this with someone who needs to hear it. Subscribe if you want more analysis like this. And stay ahead of the narrative, not behind it. This crash was a teacher. The question is whether you're willing to learn. Stay sharp out there. Think critically, verify the data, and make your own decisions.